Okay, we're back for part 2 of this lesson. In the previous lesson, we looked at how to account for foreign currency transactions and how to account for fair value hedges. In this lesson, we tackled the other type of hedge, the cash flow hedge. So for those of you who are just joining us, Parent Corporation, a Canadian corporation, has just bought an interesting piece of real estate in Texas called Bluebonnet Country. As Parent Corporation owns the land directly, the functional currency for this endeavor is the domestic currency. In other words, Canadian dollars. Now in this lesson, we're going to deal with the receipt of foreign currency. The exchange rates are the same as we saw in our previous lesson at December 15th, December 31st, and January 15th. However, the forward rates are different. And this is because we are now looking to sell US dollars, not buy them like we were in the previous lesson. The price to buy and the price to sell foreign currency is always different. The spread between the spot rate and the price to buy and sell currency is the margin being charged to you by your bank. So let's see what Bob is up to this time. Let's go back to the day that he bought Bluebonnet Country. Just when Bob thought all was dire with his land acquisition, bought sight unseen, Bob happened to come by a local builder. And during their discussions, one thing led to another, and before the day was out, Bob was able to negotiate the sale of 500 lots to the builder for, would you believe it, $1 million, due January 15th of year 2. Now from the Accounting Principles 101, we should all know the parent corporation cannot record revenue until the sale is executed. So the base case is pretty straightforward. Bob sits on his hands for 30 days and waits to receive $1 million US. And from the exchange rates we just saw, we know that when January 15th comes along, he will take back his check of $1 million US, and PICO will deposit it into its Canadian account, and the check should clear the bank for $1,070,000. There is no foreign currency exchange gain or loss to report. The whole $1,070,000 gets recorded as revenue. So that's our base case. Now let's move on to a couple of scenarios where Bob decides to hedge his foreign currency exposure to this transaction. Bob chooses to hedge this transaction by entering into a forward contract to sell $1 million US at 1.04 in 30 days. That is the $1 million he gets from the builder. So mechanically, what this agreement entails is Bob promising to deliver $1 million to US Bank in 30 days, and in return, US Bank is promising to give him $1,040,000 Canadian dollars. Why would Bob do such a thing? Well, to mitigate risk, of course. A weakening US dollar would result in less revenue. But for that, he is foregoing the potential upside from the strengthening US dollar. Let's first look at this forward contract as if it's a speculative contract. A speculative contract is one where Bob takes a foreign currency position because of his belief that the exchange rates are going to change within the next 30 days. In this case, it would appear that Bob believes the US dollar is going to weaken. So he takes a position to lock in the amount of proceeds from the bank of $1,040,000 Canadian dollars and hopes that the payable to the US Bank is less than this amount in 30 days' time. Speculative contracts don't have a cash flow transaction in mind, like our land sale, and as a result there's no gain or loss to offset against it. At year end, the US dollar payable to US Bank gets marked to the closing forward rate of 1.025. Parent Corporation recognizes a $15,000 exchange gain, and so far Bob's hunch is panning out. Our financials at the end of year 1 will reflect these balances. Keep in mind for reporting purposes that the receivable from US Bank and the payable to US Bank will be shown on a net basis as either an asset or a liability on the balance sheet. In this case, an asset for $15,000. At the settlement date of January 15th, Bob is responsible for coming up with $1 million US. I hope that land sale goes through. But note that in the speculative contract, we don't have a particular source for the US dollars in mind. Because the US dollar strengthened, Bob got screwed and realized a $45,000 loss to close out the liability to US Bank. The bank does its part and delivers Bob the $1,040,000 in Canadian cash. Oh, and by the way, Bob just so happened to sell 500 lots for $1 million US on this day as well. The sale of the lots was not specifically attached to the forward contract for foreign exchange. The year 2 financial statements would look as so. Let's run through the scenario one more time, only this time Bob really is trying to hedge his foreign currency exposure from the pending land sale. On top of that, he wants the cost of the hedge reported in the same period as the land sale. In fact, he doesn't want to see the cost of the hedge at all, which only makes sense as this is the reason he is entering into the forward contract in the first place. Let's see if we can help him out as accountants. Now that we have a true cash flow hedge in place, there are special accounting rules to consider. At the date of purchase, the entry to record the forward contract is exactly the same. However, at December the 31st, this is where the changes begin happening. We need to adjust the payable to U.S. Bank to reflect the weakening U.S. dollar. But we don't want to report a foreign exchange gain or loss because we want to treat the forward as a hedge against the future transaction. So what GAAP allows us to do when we use hedge accounting is to defer recognition of the gain by parking it in other comprehensive income. And in this situation, our financials would look like this. Once again, the receivable and the payable to U.S. Bank would be offset in the financial statements. And the $15,000 gain would reside in accumulated other comprehensive income. The day arrives that the land sale is to close. The builder pays Bob $1 million US, which parent corporation records on its books as the $1,070,000, in other words, the Canadian dollar equivalent. Now we have to square up with the bank, and Bob gives U.S. banks the $1 million US he just collected from the builder, and the difference is recorded as a reduction of revenue of $45,000. U.S. Bank does its part and gives Bob's the $1,040,000 Canadian it promised in return, which only leaves the matter of what to do with the balance that we parked in other comprehensive income at the year-end date. This balance needs to be removed from the accumulated other comprehensive income and brought into regular income by netting it against the revenue recorded. And voila! We've got a really clean looking set of statements with no sign that the hedge ever existed. And that, my friends, is a cash flow hedge. So to summarize, when Bob didn't use the hedge accounting for the forward contract, he ended up with a slightly messier set of financial statements because he had the forward contract, the forward exchange gains and losses, and the revenue to report. When Bob used hedge accounting, when all was said and done, he simply had revenue to report. Economically speaking, there's no difference between the two approaches. It's entirely a presentation decision. So who makes the call as to whether to use hedge accounting or not? Well, you do. Hedge accounting is entirely optional. However, if you do use hedge accounting for future transactions, you need to recognize that there are certain criteria that must be met. First of all, you've got to designate the hedge as a hedge up front, not after the fact, and this must be documented. The hedging instrument itself, i.e. the forward contract, must provide an effective hedge against the hedged item, which is going to be your monetary asset or liability, denominated in a foreign currency. In our foreign exchange example, it's pretty easy to see that the gains and losses offset. However, as you look to apply hedge accounting to other risks, say gas prices or commodity prices, which vary depending on a number of different factors, then the effectiveness is not a given. Which leads us to the third requirement, that the effectiveness must be tested throughout the term of the hedge. Finally, note that partial hedges are possible, but I'll leave that thought to tantalize your imagination. That's all for this lesson of really hard accounting. Until next time, don't stop to get to the top. When you get to the top, don't stop.